Hey, what's going on, everybody? Welcome back to another episode of Wealth Defense Radio, the podcast. I am your host, Josh Nahosa, and I am an independent advisor representative for SWAN DFW, which stands for Sleep Well at Night, Dallas, Fort Worth. And I am here with the man who sends overly complicated words into the family group chat to make himself sound more intelligent. It is Hector Hinojosa.
What do you mean makes it sound more intelligent, sir?
Sorry. Makes himself feel more intelligent.
You know what? I'll take that.
Hector is a certified financial planner, which is the top mark in our industry, and he started SWAN DFW a little over 10 years ago now, as we're recording this episode.
10 years and 11 months. Next month is 11 years. How about that?
Yep.
Now, I've been in the business since 1995, so it took me a while before we opened our own firm. So worked for a lot of large financial planning organizations, Bank of America, MetLife, people like that. And yeah, we like the independence of being a small niche firm.
Yeah. So why don't you tell everybody what we're talking about today?
Well, there's a lot of to-do lists coming out end of the year. What do we do for tax purposes?
We've even done,
and I thought it was excellent. But today it's don't. The things to don't do at the end of the year as part of your tax purposes. So I think maybe we'll have a little fun with it and give some good things not to do.
Yes. Everybody loves double negatives. So we're just going to give single negatives today.
Okay.
We're not going to give you like don't do.
Don't do, which is a do.
Just do.
Yeah.
So
no,
we
it's going to
already
be don't
did that.
or do, yeah.
Yeah. But before we get into that, we have a news story. Today we're in the world of fashion. Hector considers himself to be a bit of a fashionista.
Fashionista, yeah. Yeah, absolutely. People call me and say, hey, what should we do for next fall's collection?
Yes, all the time. On top of financial planning, we're also fashion
That's right.
helpers.
That's right.
So you know how things go in and out.
Assistant, sir.
Oh, sorry.
Yeah.
You know how things go in and out of style.
Yes.
Parachute pants, cargo shorts.
Were they really ever in style? Anyway.
Well.
For what?
So, after a 37-year break, there's been a fashion trend update. And we have to go into the ocean again for orcas. Because orcas, for the first time in 37 years, since the year 1987, have begun wearing salmon on their heads as hats again.
They used to do it, and then they didn't do it, and now they're doing it.
Yeah, there was a trend in the 80s that they wore...
You know what they're tracking? Bell-bottom pants.
Yeah. They, in the 80s, I guess, used to wear salmon on their heads as hats. It was first one, and then the whole pod, and then multiple pods, and then a lot of orcas were doing it. And then all of a sudden it just stopped. And now they're doing it again.
Yeah, probably all the rappers and orcas like that are leading the fashion trend. It's very interesting. What does the salmon have to say about that?
Well, they're dead. So they
you kill them
salmon
and then put them on their head.
Right, because otherwise it would swim away. Yeah.
How do they keep them on, I wonder?
You know, what a great question. And I don't speak orca to be able to ask, but I would if I was able to, you know?
Well, I think if anybody out in our listening audience speaks orca, would you give us a call so we can put you in touch with an orca?
Yeah.
And then maybe you can tell us and fill in this blank.
I'll ship you to SeaWorld or something. So, back to the don'ts of tax planning. We have a few. We're going to link the article in the description of the YouTube video or Spotify, wherever you're listening. Make sure you leave a like, maybe comment. It helps people be able to find our podcast. Share it with somebody. That's the best way.
Yeah.
But let's get into it.
And that's a do, not a don't.
Yes, that is a do.
Don't keep a secret.
The article we're pulling from will be in the description.
Right.
And it's by the Financial Advisor magazine.
Yeah.
Some interesting points are made in this. We're going to cover some of it, but if you want to read the whole thing, obviously you can just click on the link. So the first big thing here is don't take only the RMDs.
Yeah, many people, they get their RMD notice and they say, here's your RMD. It's $10,000 or $20,000 this year. And that's what people take. They want to take the least amount of money that they can take, that the government is forcing them to take out of qualified plans. Now, if you have a Roth, you don't have to mess with it. It's something to consider is if you're in a situation where, like, maybe you just retired in 2023, so you didn't have a lot of income in 2024, you may want to take more than your RMD and put whatever the overage is, just convert that into a Roth, or even just spend the money, because if you're below a 22 or 24% tax bracket, this might be the cheapest money you ever get out of your qualified plan. So if you have an RMD for $20,000 or whatever it is, you can take it out and spend it, or you can convert it. But you can also convert up to, we suggest that, you work with somebody like us where we can tell you, you can take up to this number of dollars. And when we add that number of dollars, a conversion that you've got to pay taxes on, and add it to the income, we're still going to keep you at a lower tax rate. And so don't just take the required minimum distribution. Check to see if you've got some room before you get to another tax bracket and convert that money into a Roth, or just take it out and spend it, because it's going to be cheaper now than it's going to be, in 10 or 15 years.
Yeah, and everybody's number there is different, so you want to talk to a financial professional or somebody that kind of knows, and to make sure you get all the way up to the tax bracket, the next tax bracket potentially, without going or dipping into it.
Yeah, going over it. And if you've already taken an RMD, unless you're in an annuity or something like that, but if you've already taken an RMD, you can still take more money out and convert it. And so you just need to be careful that you don't take too much that puts you in a bigger tax bracket. But yeah, taking the RMDs, it may be hurting your tax planning. One of the questions we get a lot is about tax planning. So this is one of the ways to do that. If you've got some room, take more than the RMD and get that converted.
Yeah, it's worth noting, I think, that RMD is required minimum distribution. That's not like the amount you have to take and you can't take more. That's like the minimum, like the name suggests, that you need to take without penalty.
That's right. And without penalty, but you are going to pay taxes on it. Well, this is just a way for the government to generate revenue from accounts that have been sitting for sometimes 20 or 30 years. And so, yeah.
Yeah. We touched on it, but one of the things you can do with the overages is you can throw it into a Roth.
Yep. You have to convert it, because if you don't have earned income, you can't just create. You can't make a Roth, but you can convert as much of an IRA into a Roth, whether you made any money in 2024 or not.
Obviously, we have entire episodes about this, but the advantage of a Roth is that you've already paid the taxes on that money. So when you withdraw it again later, that's tax-free, and you don't have to worry about that counting or having to pay the 22 or 24 or whatever tax bracket you're in, paying that percentage. That just is your money. The money you're pulling out, you don't have to worry about paying.
And that comes into legacy planning too. If you've been blessed enough to where you're going to leave some money to your kids, I always tell people your kids are going to love you because you left them some money. Now, if you left them some tax-free money, they may love you a little bit more. Bigger headstone or a nicer urn or something like that. But and you remove the RMD. Once you put it in a Roth, since you've already paid taxes on that money, there are no required minimum distributions on a Roth.
Yeah, so you can do with that as you please.
As you please.
Take out as much or as little.
Absolutely.
What's our next point here?
It talks about the election, and it's talking about, that the tax brackets are likely going to be, the tax cuts that Trump did in his first term are likely to be extended. So we want to talk about going ahead and even though you're taking, we're back to just taking the minimum out, this might be a very good time because tax rates are low to again consider doing something like putting more money in a Roth or taking that money out of the system completely. If you look at where we are as a country with the deficits we have, common sense will tell you that somewhere down the road, taxes are going to have to go up and spending is going to have to go down so we can start paying down even a little bit of this debt that we have. And if right now we're at historically low tax rates, and so taking advantage of that right now is a really good thing to do.
The next thing I think that's important to talk about, one of the points the article makes, is stop contributing to 401ks just for a deduction.
Well, and yeah, because we're into the same kind of circle. One of the do's that a lot of people say is, hey, if you've got some money, you got another $5,000 you can put in your IRA or your 401k, put it in at the end of the year so you get your deduction this year. But if you start thinking about, well, what's the tax plan going to be in 5 years when I retire, maybe the better way of doing that is if you have a Roth, like a Roth 401k available to you and you've got some room, stick all the money in that. Any money that you have extra, if there's any way to get that into a Roth right now, especially if you've got huge amounts of money in traditional qualified money that's all going to be taxable when it comes out, the more money we can move into a Roth, the earlier we can do that, the better for you. So, yeah, so one of the don't put a bunch of money in traditional 401ks and then next year be thinking about how do we do a conversion because you've netted zero on your taxes, right? You saved a little bit in taxes today, but you're going to pay that next year when you convert the money back out. So why not just put it in to a Roth right now if you've got some room? Yeah. I thought that was really good.
Yeah, I think the overarching thing here is talk to somebody,
right,
a professional that knows and can guide you through some of these steps because a lot of them are very complicated to figure out on your own, trying to balance what tax bracket am I going to be in, what's best for me, and when should I take more than an RMD, and when should I just take the RMD,
right.
And all of that is very complicated, and that is why you should call us.
Yeah, and we're running out of time because we're taping this on December 4th, so that doesn't leave us a lot of working days, but still we can make some moves now that will help you. You got to take a bigger picture, a larger view of things. It's not what's going to happen today in 2024. It's what's going to happen in 2030 or 2035 or 2040. The more money we put into stuff that we don't have to pay taxes on in the future, the better off you're going to be.
Yep.
That was a pretty simplistic statement. I made it sound way more complicated. No tax good, tax bad.
Yeah. So, if you'd like to talk to us, we have a couple different ways you can do that. The first way is via phone number. It's 888-792-6339. That's 888-SWAN-DFW.
And hit 1 for me and 2 for you.
Yep. 1 for Hector, 2 for me.
Yep, Josh.
And then we have an email address if you would prefer written correspondence, and that is info@swandfw.net. That's info, like short for information, at swandfw.net. All of those will be in the description wherever you're watching or listening. It's free to call, free to email.
And if you're thinking, God, I really want to meet these guys, but I don't have time to call, you can go to our website, swandfw.net. And you can see our calendar and pick a day and time that works for you and set yourself up an appointment. And the first call is about 20 to 30 minutes. And it's just, is there something for us that there is for us to help you with? It's, it's just, let's see if there's something there before we start talking about whether we can do business together. And after you talk to us, there's only like 3 things that can happen. One, you say, I hate these guys. I never want to see them again. And that's okay. We can still be friends and don't have to do business with us. The other one is, I think that they're good, but the timing is wrong. So maybe in a year or 2, that's fine. Or many people who do that say, yeah, let's go ahead and take the next step. And so it's not going to, either way, you're not going to come out bleeding or hurt or injured. So give us a call or set up an appointment through our website and let's have a conversation and see if we can't save you some money long term on taxes.
Yep. So all of that is in the description. Thank you guys for listening.
Yep.
Catch you all on the next one.
Have a blessed day.